The Federal Reserve just did something that looks quiet on the surface but tells you a great deal about the machine underneath. It did not cut interest rates, it did not raise interest rates, it froze. That is what matters. When a central bank is confident, it moves. It tightens because inflation is the priority. Or it loosens because growth is the priority. It tells the market what the main problem is and then pushes policy in that direction. But when a central bank holds rates steady in the middle of political pressure, inflation pressure, debt pressure, and economic uncertainty, it is telling you something else. It is telling you the machine has become hard to steer, and when the machine becomes hard to steer, the people whose wealth, wages, mortgages, savings, and businesses depend on that machine need to pay attention. Most people hear about the Federal Reserve and immediately tune out. They think it is just bankers talking about basis points. They think it is abstract. They think it belongs to economists, traders, and politicians. That is a mistake. The Federal Reserve affects the value of your paycheck. It affects the value of your savings. It affects mortgage rates. It affects car loans. It affects credit cards. It affects business financing. It affects stock valuations. It affects housing. It affects the national debt. It affects inflation. And because the dollar is the world's reserve currency, it affects the entire global financial system. So when the Fed pauses and the vote becomes unusually divided, that is not just a technical announcement, it is a signal of conflict inside the system. There are really three things happening at once. First, the Fed is refusing to cut rates even though political pressure for lower rates is rising. Second, the vote inside the Fed has become deeply divided because different members are seeing different dangers. Some fear inflation and the dollar, others fear economic weakness and unemployment. Third, the leadership structure itself is changing because Jerome Powell's term as chairman is ending, but he may not fully leave the Federal Reserve Board, which means his influence may continue even after a new chair takes the microphone. On the surface, this is a story about interest rates underneath. It is a story about a debt-heavy country that wants lower rates, an inflation problem that makes lower rates dangerous, and a central bank trying to protect credibility while politicians want relief. That is the real story. The Fed's decision not to cut rates is important because lower rates are what many people want. Homebuyers want lower mortgage rates. Businesses want cheaper capital. Stock investors want easier liquidity. The government wants lower interest costs. Politicians want an economy that feels stronger before voters get angry. But the Fed also has to watch inflation. And inflation is not dead. Oil prices are higher because of conflict and instability. Higher oil does not only affect gasoline, it moves through diesel, shipping, fertilizer, food, plastics, packaging, and transportation. When oil rises, almost everything that has to be grown, moved, heated, cooled, packaged, or delivered can become more expensive. That is why the Fed is trapped. If it cuts rates now, it may stimulate spending, credit, housing demand, and asset prices. At the exact moment oil is pushing inflation pressure higher, that can weaken the dollar and make inflation harder to control. But if it raises rates, it may damage an economy that is already showing cracks. Companies are cautious. Hiring is weakening in some areas. AI is beginning to change labor demand. Borrowers are tired, consumers are stretched. Housing is already expensive. Small businesses are sensitive to financing costs. This is the dilemma. Cutting rates helps growth but risks inflation. Raising rates fights inflation but risks recession. Holding steady avoids choosing, but it does not solve the underlying conflict. It only delays the decision. In a normal cycle, this would be difficult enough. But this is not a normal cycle because the United States government is carrying an enormous debt load. That debt changes everything. The United States has more than $39 trillion of national debt in the framework being discussed here. That means the government has spent far more than it has collected over many years and filled the gap by borrowing. It borrowed from individuals, it borrowed from institutions, it borrowed from foreign governments, it borrowed from pension funds, it borrowed through the Treasury market, and in periods of crisis it has been supported by the Federal Reserve's balance sheet. Now the interest cost on that debt has become one of the central problems in the entire economy. The government is paying more than $1 trillion a year in interest. That is not money going to build roads. It is not money going to improve schools. It is not money going to modernize infrastructure. It is not money going to defend the country more effectively. It is not money reducing the principal. It is rent on past borrowing. That is the net interest trigger. At some point, the cost of carrying the debt becomes so large that it starts to shape policy itself. If around 20 cents of every tax dollar is going toward interest, then the government is no longer only funding future priorities. It is servicing the past. That changes the Federal Reserve's problem. The Fed was created to deal with money, banking, inflation, and employment. Its traditional public framework is maximum employment and stable prices. But when the government's debt is enormous and interest costs become enormous, the Fed's decisions also become decisions about whether the government can finance itself at acceptable rates. That is the uncomfortable truth. The Fed can say it is focused only on inflation and employment, but the debt market sits underneath everything. Treasury yields are the foundation of global finance. Mortgage rates are priced off Treasury yields. Corporate bonds are priced off Treasury yields. Bank lending is influenced by Treasury yields. Asset valuations are influenced by Treasury yields. And the government's own budget is deeply affected by Treasury yields. So when debt becomes large enough, the Fed cannot ignore interest cost even if it does not want to say that out loud. This is where the system begins to shift. The Fed may no longer be only managing inflation and employment. It may also be managing the debt machine that is not an official slogan. It is a structural reality. Now we have a leadership transition layered on top of this. Jerome Powell has been the face of the Fed's resistance to cutting rates too early. He has been under political pressure to lower rates, but he has said the Fed must be careful because inflation remains a risk. A new chair, Kevin Warsh, is expected to come in under the framework of the source. The political expectation is that a new chair may be more willing to cut rates. But the situation is not as simple as replacing one person and changing the entire machine. The Fed is not a dictatorship. The chair is powerful, but decisions require a voting process. There are multiple voting members. The institution has internal divisions. If Powell steps down as chair but remains on the board, his vote and influence may still matter. That is why the leadership change may not create the simple rate cut machine that some politicians want. The old chairman may no longer be the public face, but the old influence may remain inside the room. And because the latest decision produced one of the most divisive votes in decades, the split inside the Fed may matter more than the title outside the room. That split tells you the problem is not personal. It is structural. Some officials want tighter policy because inflation and dollar credibility matter. Others want easier policy because the economy and debt burden are under pressure. Both sides have evidence. Both sides have risk. That is what makes the decision difficult. When both sides are right about different dangers, the system becomes unstable. Now, Kevin Warsh's proposed approach is especially important because it tries to solve two problems at once. Cut interest rates to stimulate the economy, shrink the Fed's balance sheet to reduce inflation pressure. At first, that sounds elegant. Lower rates make borrowing cheaper. They can help mortgages, car loans, business loans, and asset prices. They can stimulate demand. They can make the economy feel better. Shrinking the balance sheet is the opposite force. If the Fed sells or lets run off the assets it holds, it removes liquidity from the system. In theory, this can offset the inflationary pressure of cutting rates, so the idea is to cut on one side and tighten on the other. Stimulate through the price of money, restrict through the quantity of money. But the problem is that the Treasury market is not theoretical. If the Federal Reserve reduces its holdings of treasuries, then someone else must buy those treasuries. The United States government is still issuing debt. It is still running large deficits. It still needs buyers. If the Fed becomes a smaller buyer or a seller, then private investors, foreign governments, pension funds, banks, insurance companies, and other buyers must absorb more supply. If they do not absorb it at current yields, yields rise. That is supply and demand. When the government needs to borrow enormous sums, and there are fewer buyers at a given rate, the government must offer a higher rate to attract buyers. Higher Treasury yields can then push up mortgage rates, bank lending rates, corporate borrowing costs, and the cost of capital throughout the economy. So the policy plan contains a tension. Cutting the Fed's policy rate may lower short-term rates, but shrinking the balance sheet could push longer-term Treasury yields higher if private demand is not strong enough. That matters because mortgages and many business financing costs are tied more closely to longer-term yields than to the Fed's overnight rate. So a new chair could cut short rates and still fail to bring mortgage rates down if the bond market demands higher long-term compensation. That is one of the most important things ordinary people need to understand. The Fed does not directly control every interest rate. It influences the structure. But the bond market has its own power. The government cannot simply demand lower rates if lenders are not willing to accept them. Lenders must be persuaded. They must believe inflation will be controlled. They must believe the dollar will retain purchasing power. They must believe deficits are manageable. They must believe they are being paid enough for the risk. If they do not believe those things, they demand higher yields. This is the danger of the Warsh plan. It may work if private demand for treasuries is strong enough. It may fail if bond investors demand more compensation. If it fails, the result could be a strange environment where the Fed is trying to ease but long-term rates remain high or even rise. That would be a very difficult environment for housing, businesses, and the government. Now, Warsh reportedly believes private demand will be enough. He believes that if the Fed reduces its balance sheet, other buyers will step in. Maybe he is right. But the question every serious investor should ask is why? Who are the buyers? At what yield? With what incentives? Are foreign buyers increasing or reducing exposure? Are domestic institutions being encouraged or pressured to buy more treasuries? Will banks be given regulatory incentives? Will pension funds shift allocation? Will the government create policies that make treasury ownership more attractive or necessary? These are the real questions. When debt supply becomes too large, governments often try to shape demand. They can do it openly, they can do it through regulation, they can do it through bank capital rules, they can do it through pension guidance, they can do it through financial repression. They can do it by making treasuries appear safe and necessary for institutional portfolios. This is not new in history. When governments have large debts, they look for captive buyers. That is how debt systems survive. So when a policymaker says private demand will absorb the supply, do not simply accept the phrase, ask what creates that demand. Because if demand is voluntary, yields may have to rise enough to attract it. If demand is policy-driven, then we may be entering a more repressive financial environment. Either way, the consequences matter. Now, we also have to talk about inflation measurement. The source mentions that Warsh may want to redefine inflation or change the way inflation is understood. This is important because inflation is not only an economic statistic, it is a political and monetary tool. The way inflation is measured affects public perception. It affects cost of living adjustments. It affects Social Security. It affects wages. It affects bond markets. It affects the Fed's credibility. It affects whether policymakers can claim success. Many people already feel that official inflation numbers do not match their lived experience. They see rent, home prices, insurance, groceries, childcare, healthcare, property taxes, and car costs rising far more than the headline number suggests. That creates distrust. When a person hears that inflation is 3%, but their real cost of living feels much higher, they stop trusting the statistic. The technical measurement of inflation has changed over decades. Housing is measured differently than many people experience it. Substitution effects, hedonic adjustments, and weighting decisions can all make official inflation feel different from household inflation. This is not only a technical issue, it is a confidence issue. If the Fed changes how inflation is defined, the public may become even more suspicious. If the new definition makes inflation appear lower, it can create room for rate cuts. It can make policy easier to justify, it can reduce political pressure, but it does not reduce the real cost of living if the things people buy are still rising. This is the difference between measured inflation and lived inflation. Measured inflation is the statistic. Lived inflation is what your paycheck can buy. For most people, lived inflation matters more. If your official inflation rate is 3%, but your rent, insurance, groceries, and transportation costs are rising much faster, then your financial life is being squeezed regardless of the headline. This is why the value of your paycheck matters. Inflation is not abstract. It is a reduction in purchasing power. If your wages rise 4%, but your real cost of living rises 8%, you are poorer in real terms. The number on your paycheck went up, the life that paycheck can buy went down. That is how inflation quietly taxes workers and savers. And this is why Fed policy matters so much. If the Fed cuts too aggressively and inflation rises, your paycheck loses value. If the Fed raises too aggressively and the economy weakens, your job may be at risk. If the Fed holds rates too long, debt costs remain high. If the Fed shrinks the balance sheet too quickly, the bond market may force rates higher. There is no painless path. The problem is not that policymakers are stupid. The problem is that the debt cycle has reached a stage where every option has a cost. Now, the source also says Warsh may reduce press conferences and abandon forward guidance. That would be a major change in communication. Forward guidance is the Fed's way of preparing markets for future policy. It gives hints. It shapes expectations. It helps investors, banks, companies, and households anticipate what the Fed may do. Markets have become deeply dependent on this guidance. Investors parse every word. They study the dot plot, They listen for one changed phrase. They build trades around expectations of the next move. If the Fed reduces guidance, markets may become more volatile. On one hand, less guidance could give the Fed more flexibility. It would not be trapped by promises. It could respond to data more freely. On the other hand, markets hate uncertainty. If the Fed becomes less communicative, investors may demand more risk premium, bonds may move more sharply, stocks may become more volatile, mortgage markets may react more aggressively to data. This is another trade-off. Transparency can stabilize expectations, but too much guidance can make markets dependent on central bank reassurance. Less guidance can restore discipline, but it can also create instability. Again, there is no perfect answer. This is why the Fed's communication strategy matters almost as much as the rate decision itself. In the modern market, policy is not only what the Fed does. Policy is what the market believes the Fed will do. Expectations move markets before actions happen. That is why communication is policy. Now, what does all of this mean for regular investors? It means the next phase may be more volatile than people expect. If the Fed is divided, leadership is changing. Inflation is still alive, oil is pressuring prices, the balance sheet strategy is uncertain, and the bond market must absorb more treasury supply, then the path of rates becomes harder to predict. Stock investors should care because valuations depend heavily on interest rates. When rates fall, future earnings are discounted at lower rates, and stocks can look more attractive. Growth stocks especially benefit when long-term rates fall. When rates rise, valuations can compress. Companies with weak cash flows, high debt, or distant profits can be hit hard. Housing investors should care because mortgage rates determine affordability. A small change in mortgage rates can change monthly payments dramatically if long-term yields rise because the bond market does not like the Fed's balance sheet plan. Housing may remain stuck even if short-term policy rates are cut. Workers should care because inflation affects wages and living costs. If the Fed cuts too early and inflation reaccelerates, wages may fail to keep up with real expenses. That means your paycheck loses power. Savers should care because inflation erodes cash. If policy becomes easier and inflation remains high, cash balances may feel safe but lose real value. Borrowers should care because rates determine debt service, credit card rates, car loans, mortgage rates, and business loans all sit inside the broader rate structure. This is not distant, it is in your wallet. Now, let us think about the debt problem more deeply. The government's interest expense is like a giant household credit card bill, except the household can tax and print. The fact that it can tax and print means it will not run out of dollars in the same way a family can run out of dollars. But printing dollars is not free. The cost shows up in purchasing power. If the government prints too much or if investors lose faith, the dollar weakens and inflation rises. That is why debt can be repaid in nominal terms but still default in real terms. A government can always hand you dollars. The question is what those dollars buy. That is the real standard. If you lend money to the government and get paid back in dollars that buy much less, you were paid back legally but not economically. This is financial repression. It is subtle, it does not look like default, it looks like inflation, low real rates, and savers quietly losing purchasing power. When government debt is large, financial repression becomes tempting. Keep rates below the real inflation rate. Make institutions hold government debt, allow inflation to reduce the real burden, use measured inflation in ways that create policy room, support markets when needed, avoid explicit default. This is how large debt burdens are often managed. That is why the Fed's dilemma is so important. If it focuses too much on inflation, it may keep rates high and worsen the government's interest burden. If it focuses too much on the debt burden and cuts rates, it may weaken the dollar and worsen inflation. If it shrinks the balance sheet, it may remove liquidity and pressure. Long-term rates, if it expands the balance sheet, it may support markets but worsen debasement risk. Every path transfers pain to someone. The question is who: workers through inflation, savers through negative real returns, borrowers through high interest rates, asset owners through valuation shocks, taxpayers through future obligations, bondholders through real losses. There is no cost-free solution. Understanding that helps you avoid naïve thinking. Now, what should a person do with this knowledge? First, stop thinking of cash as automatically safe. Cash is useful for emergencies and flexibility. You need it, but if inflation remains above what your cash earns, then cash is losing purchasing power. It is safe in nominal terms and unsafe in real terms. Second, avoid high interest debt. If the rate environment remains uncertain, credit card debt and expensive consumer loans are dangerous. They are compounding against you at a time when wages may not keep up with real costs. Third, own productive assets. Businesses with pricing power can raise prices when costs rise. They can preserve margins. They can grow nominal earnings. Broad equity ownership can help protect against long-term currency debasement, though stocks remain volatile. Fourth, consider the role of hard assets and inflation. Sensitive assets, real estate, commodities, gold, energy infrastructure, and other real assets can play a role, though each has risks. The point is not to chase them blindly. The point is to avoid a portfolio made only of cash and nominal promises. Fifth, keep duration risk in mind, long. Duration bonds can be vulnerable if inflation remains sticky or if the bond market demands higher yields. Shorter duration instruments may reduce interest rate sensitivity, though they still face reinvestment and real return risk. Sixth, remain diversified because policy is uncertain. Do not build a portfolio that depends on one rate path. If your portfolio only works if the Fed cuts aggressively, it is fragile. If it only works if inflation collapses, it is fragile. If it only works if the dollar stays strong forever, it is fragile. A resilient portfolio works across more than one future. That is the Dalio principle. Do not predict one path with certainty. Build for multiple paths. Now, let us examine the possible scenarios. Scenario 1, the Fed cuts rates, inflation stays contained, and private demand absorbs treasuries smoothly. That would be the soft landing path. Stocks may rally, housing may improve, debt service may become easier, the dollar may hold up if investors trust the process. This is the optimistic scenario. Scenario 2, the Fed cuts rates, but oil and inflation rise again. In that world, the dollar may weaken, long-term yields may rise, and real assets may outperform cash. Households may feel poorer, even if asset prices rise. The Fed may have to reverse course or tolerate higher inflation. Scenario 3, the Fed shrinks the balance sheet and private demand for treasuries is not strong enough. Long-term yields rise, mortgage rates stay high or rise, the government's interest burden worsens. Markets become volatile. The Fed may be forced to slow or reverse the balance sheet reduction. Scenario 4, the Fed refuses to cut because inflation remains too high, the economy slows, job risks rise, stocks may struggle, borrowers remain pressured. Eventually, if the economy weakens enough, the Fed may be forced into emergency easing. Scenario 5, the government or regulators create stronger incentives for institutions to hold treasuries that can stabilize debt demand, but it may create financial repression. Savers and institutions may be pushed into holding government debt at yields that do not fully compensate for inflation. No one knows which path will dominate. That is why portfolios should not depend on certainty. The Fed is not all-powerful. It is powerful, but it operates inside constraints. The oil market is a constraint, the debt market is a constraint, the dollar is a constraint. Inflation expectations are a constraint. Political pressure is a constraint. Labor markets are a constraint. Market liquidity is a constraint. The next chair may want to change the direction, but the machine will push back. This is why I never focus only on personality. A new leader matters, but the machine matters more. A person sitting in the chair can change communication, emphasis, and tactics. But he cannot make $39 trillion of debt disappear. He cannot make oil prices irrelevant. He cannot make bond investors buy at low yields if they are afraid of inflation. He cannot make households feel rich if wages do not keep up with living costs. Policy choices happen inside reality. Reality eventually wins. Now, let us talk about the public. Most people will not understand this transition until they feel it. They will feel it when mortgage rates do not fall the way they expected. They will feel it when groceries stay expensive. They will feel it when insurance premiums rise. They will feel it when wages look higher but life feels harder. They will feel it when savings accounts earn interest but still fail to keep up with the cost of living. They will feel it when stocks rally but their personal finances do not improve. That is one of the strange features of inflationary debt cycles. Asset owners may feel wealthier, workers and savers may feel poorer. The same policy can create both. Lower rates and liquidity can raise asset prices. But if that liquidity also weakens the currency, people who depend on wages and cash suffer. This widens inequality. It is not always intentional. It is structural. People who own assets benefit from asset inflation. People who only earn wages and hold cash are exposed to consumer inflation. This is why owning assets matters. Not because stocks always go up. Not because real estate always wins. Not because gold is magic. because in a system where the currency may be diluted to manage debt, asset ownership is one of the few defenses against purchasing power loss. That is the deeper lesson. Now, there is a danger in becoming too reactive. Every Fed meeting produces headlines, every speech produces interpretations, every inflation print produces panic or euphoria. Every oil move becomes a new narrative. Every leadership rumor becomes a market story. If you allow every headline to change your plan, you will not compound, you will react. A good investor watches the Fed but does not worship the Fed. The Fed is important, but your financial life should not depend on predicting every meeting. You should understand the broad forces: high debt, sticky inflation, oil risk, political pressure, treasury supply, balance sheet uncertainty, dollar credibility. Then build a strategy that can survive those forces, not a strategy that requires guessing the next sentence in the next press conference. Now, what would a sensible individual plan look like in this environment? First, maintain emergency liquidity. You cannot invest well if one surprise expense forces you into debt. Second, reduce expensive debt. High-interest debt is a guaranteed drag. Third, invest consistently into productive assets if your time horizon is long enough. Fourth, diversify across asset classes. Fifth, understand real returns. Ask what you earn after inflation and taxes. Sixth, avoid overexposure to long-duration nominal promises if you cannot tolerate inflation or yield shocks. Seventh, keep some flexibility. A world with policy transition can create volatility and opportunity. Eighth, improve earning power. Inflation hurts less when your skills and income rise faster than prices. Ninth, do not assume official inflation equals your personal inflation. Track your own real cost of living. 10th, think in terms of purchasing power, not just account balances. That is a practical response. The goal is not to predict the exact Fed path. The goal is to avoid being fragile under multiple Fed paths. Now, let us return to the Fed's internal division. A divided Fed is not just a political story. It means the economic data is sending conflicting signals. Inflation says be careful. Debt says be careful. The economy says be careful. The labor market says be careful. Oil says be careful. The market wants cuts. The government wants lower interest costs. The dollar wants credibility. Those forces are pulling against each other. When a committee is divided, it is usually because the system itself is divided. This is why the most divisive vote in decades matters. It tells you there is no easy answer. If the answer were obvious, the vote would not be split. The split is a signal of uncertainty, and uncertainty usually creates volatility. Markets may rally on expectations of easier policy, then sell off if inflation data disappoints, then rally if growth weakens and rate cuts become more likely, then sell off if Treasury yields rise because of supply concerns. This kind of environment can whipsaw emotional investors. That is why process matters. A process lets you act without needing certainty. If your target allocation says you should own a certain amount of equities, bonds, cash, and real assets, you rebalance when they move too far. If markets fall, you buy according to plan. If markets rise too far, you trim risk according to plan. You do not let headlines become your portfolio manager. The Fed may be divided. Your plan should not be. Now, what about the dollar? The dollar's role as reserve currency is still a major advantage. The entire world uses dollars for trade, debt, reserves, and liquidity. That gives the United States room other countries do not have. But reserve currency status is not a blank check. It is a privilege that depends on trust. If the world believes the United States will manage inflation, protect purchasing power reasonably, and maintain deep liquid, reliable markets, demand for dollars remains strong. If the world begins to believe debt is being managed through debasement, demand may shift at the margin. Again, the dollar does not need to collapse for this to matter. A small reduction in foreign demand for treasuries can affect yields. A weaker dollar can raise import prices. A loss of confidence can force tighter policy or more financial repression. Reserve currency privilege gives time. It does not eliminate consequences. This is why the Fed's credibility is so important. If the Fed cuts rates under political pressure while inflation is still sticky, markets may question whether the central bank is defending the currency or serving the government's interest burden. If the Fed stays too tight and damages the economy, political pressure intensifies. This is the narrow bridge. The Fed must appear independent enough to defend inflation credibility while flexible enough to prevent a financial accident. That is a very difficult job. Now, if Warsh reduces forward guidance, the market may have to relearn uncertainty for years. Markets became accustomed to central banks explaining the path, Investors were trained to expect signals. If those signals become weaker, risk management becomes more important. This could be healthier in the long run because markets should not rely on central banks to remove all uncertainty. But in the short run, it may be destabilizing. The market likes a parent in the room if the parent stops explaining every next move. The child may become anxious. That anxiety is volatility. Now, inflation redefinition is another confidence risk. If people believe the Fed is changing the measurement to make the problem look smaller, trust may weaken. If trust weakens, inflation expectations can become harder to control. And inflation expectations matter because when people expect higher inflation, they behave differently. Workers demand higher wages. Businesses raise prices more aggressively. Consumers buy sooner to avoid future increases. Lenders demand higher yields. The cycle can reinforce itself. So changing inflation definitions is not just a statistical matter. It is a credibility matter. Credibility is one of the most valuable assets a central bank has. Once lost, it is hard to rebuild. That is why the Fed's next phase is so important. It is managing not only rates, but trust in the dollar. Trust in inflation measurement, trust in Treasury demand, trust in Fed independence, trust in policy communication, trust in the system's ability to manage debt without destroying purchasing power. When a debt-heavy system loses trust, the adjustment can become fast. That is why policymakers are cautious. Now let us bring this back to the ordinary household. If you live on a paycheck, the main question is not whether the Fed funds rate is 4% or 5%. The main question is whether your wages are rising faster than your cost of living. If you are saving cash, the question is whether your cash return is beating your personal inflation. If you have a mortgage, the question is whether rates will let you refinance or whether you can carry the current payment. If you want to buy a home, the question is whether rate cuts actually improve affordability or whether home prices rise again when buyers return. If you own stocks, the question is whether companies can grow earnings in real terms. If you own bonds, the question is whether your yield compensates for inflation and rate risk. If you own no assets, the question is how you will protect yourself if the dollar loses purchasing power. This is how Fed policy enters your life, not as theory, as cash flow, as affordability, as purchasing power, as asset prices, as debt service. The average person thinks the Fed is distant, the Fed is in the grocery aisle, the Fed is in the rent check, the Fed is in the mortgage quote. The Fed is in the credit card statement. The Fed is in the retirement account. The Fed is in the value of the dollar sitting in your bank. That is why this moment matters. Now, how do I think about the coming transition in one framework? The system has too much debt to tolerate very high rates indefinitely. The system has too much inflation risk to cut rates recklessly. The system has too much treasury supply to shrink the balance sheet without consequences unless private demand is strong. The system has too much political pressure for the Fed to remain purely academic. The system has too much global importance for the dollar to be managed carelessly. Therefore, policy will likely be messy. Messy policy creates volatility. Volatility creates opportunity for prepared investors and danger for emotional investors. That is the framework. It is not a prediction that stocks crash tomorrow. It is not a prediction that gold goes straight up. It is not a prediction that rates go to one place. It is a recognition that the machine is under pressure from several directions at once. When machines are under pressure, you reduce fragility. You do not build your life around one clean outcome. Now, if the Fed cuts and stocks rally, a diversified investor participates. If inflation returns and hard assets rise, a diversified investor has some protection. If yields rise and bonds fall, a diversified investor avoids excessive duration concentration. If recession hits, an investor with cash and no high-interest debt can survive and buy. If the dollar weakens, an investor with real assets and productive assets may be better positioned. This is what resilience looks like. It is not dramatic, it is balanced. The people who will be hurt most are usually those with no margin, high debt, no emergency fund, too much cash losing value, no productive assets, large variable rate exposure, a job at risk. No plan. Those are the people who feel policy mistakes directly. That is why personal finance and macro are connected. You cannot control Fed policy, but you can control how exposed you are to its mistakes. Now let me be very clear. There is no perfect asset for this environment. Stocks can fall, bonds can fall, gold can fall, real estate can fall. Cash can lose purchasing power, crypto can crash, businesses can fail. The point is not to find the one asset with no risk. The point is to avoid concentrating all risk in one place. If you hold only cash, you bet on the dollar's purchasing power. If you hold only long bonds, you bet on stable inflation and falling yields. If you hold only stocks, you bet on earnings and valuations. If you hold only real estate, you bet on local property markets and financing. If you hold only gold, you bet on monetary distrust and scarcity. Each bet has a failure mode. A portfolio is a way to respect that you do not know the future. That is the all-weather principle. Now, the Fed's decision to pause tells us it does not know either. That is not an insult, it is reality. Nobody knows exactly where the economy is going. The Fed has models, it has data, it has staff, it has history, but it does not know the future. That is why it paused. And if the central bank does not know, ordinary investors should be humble. Humility does not mean doing nothing. Humility means building a plan that does not require omniscience. That is the final lesson. The Fed did not cut because inflation is still too dangerous. It did not raise because the economy is too fragile. The vote was divided because the system is split. Powell's continued presence may keep resistance to political rate cuts alive. Warsh's plan may try to cut rates and shrink the balance sheet at the same time. But that plan depends on private demand absorbing Treasury supply. If private demand is not enough, long-term rates may rise. If rates rise, mortgages, loans, government interest costs, and markets are affected. If inflation is redefined, trust becomes an issue. If forward guidance is reduced, volatility may rise. And through all of it, your paycheck and savings are exposed to the value of the dollar. That is the chain. Once you see the chain, you stop reacting to headlines and start designing around systems. Do not wait for the Fed to protect your purchasing power. Build your own protection. Keep liquidity. Avoid expensive debt. Own productive assets. Understand real inflation. Diversify control. What you can control, think in purchasing power. Expect policy to be messy. And remember that the biggest financial risks often begin quietly, in rooms where people vote on rates while the rest of the country is still arguing about the price of groceries. By the time most people understand the policy shift, they will already feel it. The prepared person sees it earlier and adjusts calmly. That is the difference.